Welcome back to this edition of the Note versus Alternative Investment Series, Part 3, Notes versus Rehabs. In this video, we'll take a look at how notes stack up to rehabs, or what's also known as fix and flips or distressed properties. And just so we make it as fair as possible, we're going to have a non-performing note go head-to-head with a rehab property. Because a non-performing note is very similar to a rehab because both of these assets are typically purchased at a significant discount. First, the attraction to rehabs is usually the entry price. This is the biggest factor in the rehab business because in order to make money with a rehab, the investor needs to keep their costs as low as possible in order to maximize their return on capital. Now, there are other factors to consider as well, but this is the biggest factor since it affects the bottom line profit at the completion of the deal. So let's take a note that's $50,000 and put it up against the $50,000 rehab and see how they fare. The first thing to consider is that both the note and the rehab will be purchased at a marginal discount. We do this so that the price doesn't reflect the current value of the asset, just the cost in order to acquire it. The non-performing note is also purchased at a discount because the borrower is not making their monthly payments. And since the note is collateralized by the house, we can expect to pay around 30 to 50 cents on a dollar when acquiring the note. So, we paid up to $50,000 for about a $100,000 note that hasn't been performing. Also, the asset is going to be worth substantially more than the note because it's a tangible asset based off the market value. In other words, this asset is purchased at a discount of up to 70%. And typically, we don't even need to do any major rehabs with it. Now, you can generally obtain a rehab around 70 to 90 cents on the dollar at market value. So, at best, you can purchase the house, in this example, with a market price of about $60,000. Even bank-owned or real estate-owned properties are generally purchased at 70 cents on the dollar, and then quickly resold with a 10 to 15% profit margin. In this example, the rehab will take on average around 90 days to have a contractor to get the house up to local billing codes. It could take even longer if you attempt to do it yourself and you're new to the business. As you can see, the non-performing note has a lower cost barrier to overcome with its price point because it has a higher discount rate. And because it's a non-performing note, we don't actually own the house, we own the note. But we do have many more options available to us in the financial space. We could do any of the three following things. 1. Modify the loan and have a borrower start paying again, giving us a passive monthly income. 2. We could give them cash for keys and have them sign a deed in lieu of foreclosure, giving us the property. Or we could choose an option to actually foreclose and take the property back. Here's a little insider knowledge. It normally doesn't cost more than $3,000 to have a foreclosure done for you. And then you're free to do what you want with a tangible asset. On the other hand, the rehab is a business that has limitations on what you can do with the house once you acquire it. But before you can do anything with your asset, you need to bring it up to code and spend your resources on getting the asset to be presentable to the marketplace, all while hoping the house doesn't need any major unforeseen repairs that will deplete the profit. You're limited in your options to basically fixing up the house and selling it on the retail market and getting what the market will bear for your time and effort. And yes, you can turn it into a rental for a long-term cash flow, but as you've seen in Part 2, the note versus rental video, this wouldn't be the best return for your investment methods. But for now, the only option you have is to sell the asset on the open market and hope the market will allow you to sell for top dollar. The biggest benefit to incorporating this strategy into your portfolio is that you can choose to do these in either your IRA or for a truly passive monthly income once they resolve. So you're able to invest with a lower entry cost and then keep all the principal and interest payments every month. And remember, if you really wanted to, you could sell a partial once the note has seasoned a bit, allowing you to replicate the process and still keep future payments for payoffs. Either way, you're able to take advantage of the flexibility of notes and have multiple avenues that allow your money to grow with a substantial approach to wealth generation. So there you have it. Once again, we think there's a clear winner by investing with notes. We hope you like this educational series of notes versus alternative investments to help you see why notes are part of building true generational wealth. We'll see you again next time at Part 4, Notes versus Wholesales.